Hi everybody, welcome to the webinar. This is a webinar on blockchains and smart contracts, and is really looking at a high-level overview of what blockchains are, why they're interesting, why your company needs to know about them, and how smart contracts fit into that. My name is Josh Rosenblatt. I'm a principal with Blackline Payments Advisors, which is an affiliate of Frost Brown Todd. With us also is John Wagster, who's a member of Frost Brown Todd, and Michael Winkelspecht, who's the CEO of GEM, who we're really excited to have with us. GEM is really on the forefront of what's going on in blockchain technology, and it's nice to hear there's so much in this space that is being written, and some of it's valuable and some of it's less valuable, but being able to hear directly from one of the big players in the industry is really, really valuable. So with that, I'm going to let John sort of start us off. When we were talking to people about what made sense for this webinar, we basically got feedback in two different categories of people. One who knew very little about blockchains and wanted to know more, and those who were pretty familiar with what was going on. And so we're targeting this one toward the former group. So there's a lot of high level at first to try to make sure everybody's on the same page. And with that, John, I'll kick it over to you.
All right, thanks, Josh. So we're moving here from either the oldest presenter to the youngest presenter, or the least knowledgeable to the most knowledgeable. You take your pick. Both of those apply. I'm going to start out with a high-level discussion of what the blockchain is. We've all heard of it synonymously. A lot of times the term blockchain is used by the general public synonymously with Bitcoin, which is the world's largest cryptocurrency. That's actually not the case. The blockchain is the technology behind the cryptocurrency. Are the slides available?
Yeah.
I mean,
here.
Oh, I've got them here. I just want to make sure that the audience can see them.
There we go.
My slides are not particularly interesting, but Josh's are great. I don't want you to miss out on them. So really, blockchain is to Bitcoin as the TCP protocol is to the internet. We look at the internet now and we see it's this broad worldwide connection of people. But what makes it possible is the TCP protocol. It was invented, I don't know, probably back in the 80s, and it was first got real traction in the 90s when we first got email. I think it was 1994 for me. And now look at it. There's all the uses that are going on right now we never could have envisioned in 1994. But it's going through the roof with cloud storage and cloud applications and software as a service. And there's all sorts of things the internet does now that were not available when TCP was first conceived. I think that's where we are with blockchain right now. It's thought by many to be the most revolutionary technology in a long time since the internet. And they think it's probably best suited to run the Internet of Things. The Internet of Things where all things are connected and you get tremendous efficiencies and remove inefficiencies. And the blockchain technology can be used for that in many different ways. But when you break it down to its essence, the blockchain is just a ledger. It's a collection of accounts. Our law firm uses ledgers for accounts receivable, accounts payable, how many hours are billed, who pays their fees, how many fees do you have in escrow. All those are just ledger items. But the difference between the blockchain as a ledger is that traditional ledgers are centralized and private. By centralized means they have one owner. One person controls them. And they're private. Nobody can see them because it's your own information. It mostly deals with payments, and you don't want other people to see them. The blockchain is revolutionary because it's decentralized, so it doesn't have one owner. It has many owners. In fact, anybody can be a participant and owner of it in the Bitcoin context. And it's public. It's completely transparent, so anybody who has access to it can see the entire blockchain. They can see all the transactions that have gone on and are built into it. So that's a lot to digest. I'm going to try and break it down a little bit more. So why is the blockchain a game changer? Most ledgers are private. We keep them ourselves because we feel like it's our information. We trust them to maybe our banks who keep our accounts, or our accountants, maybe our brokers, or stock exchanges that hold value of our investments. They're generally private. The blockchain, however, has multiple parties, even parties with adverse interests that can make and track entries with complete transparency. So no individual party controls the blockchain. It's controlled by all the participants with it. Imagine the efficiencies we could gain if there were a hack-proof way to exchange value with others. One way to exchange value, of course, is money. but the blockchain is really going to force us to rethink about what needs to be private in our lives. Is it private because that's what we've had, that's our information needs to be private, or might it be better off if some of it is public and transparent? Think about, for example, a stock exchange where you didn't have an exchange. You were able just to go online and trade stocks through a blockchain-enabled exchange, for lack of a better word. We need a new word, perhaps. But there would be no third-party transaction fees. All the transactions could be verified by all the individual parties. It'd be complete transparency. Think about all the money you could save. A lot of governments are afraid of it because they're afraid they lose control of the knowledge that goes into an exchange like that, and that's a consideration. Josh is going to talk later about the many dozens of issues of potential uses for the blockchain going on now. So how does blockchain work? These are general statements that I'm making here because the blockchain can be configured for different users in different ways. There's public blockchains where anybody can use them. There can be private blockchains where you have very tight rules, so only a subset of users can take advantage of them. So a lot of these statements are attempted to be general statements just to help you understand what the blockchain is. At its essence, the blockchain allows collective bookkeeping. It's maintained through a network of computers. So it's not one individual. It's numerous individuals, can be numerous individuals, and they're not connected. They don't know each other. They just cooperate using the set of rules that's put together by the blockchain owner to collaborate via the internet. So it's all internet access. It's through individuals who volunteer for the most part, or in the case of a private blockchain, they could be hired to manage the blockchain. Most blockchains are publicly available. There are many providers now who are offering their version of the blockchain as open source code because they're angling to have their platform be the platform of choice for future blockchain users. So IBM has one. A number of entities have blockchains. You can go online and you can download one. In fact, when Bitcoin first came out, or when I first became aware of it, I actually downloaded the blockchain because I just thought that sounded cool. And I thought, what does it mean? Anybody with 32 gigs of hard drive, I think that's what it was, can download it. And once you have a blockchain, you're a participant. You can see it. It's on your computer. And every time it changes, it can automatically upload so that you have a copy of your cryptocurrency exchange there with you at all times. Another characteristic of the blockchain is that, again, for public blockchains, is that transactions are anonymous. There's not a name associated with them, yet they're transparent. So people can see them. They see that they take place, but they can't be traced to an individual in the cryptocurrency sense, or for the use of Bitcoin. Private exchanges could use names if they want to, just be a characteristic of that particular use. Another fascinating, particularly for legal purposes, and useful attribute of blockchains is that all transactions are logged and stamped with information about the time, the amount of the transaction, and the participants that are there, if not by name, by number, or whatever other coding device. So it's like having a notary present every time you do a transaction. And once it's built into the blockchain, it's transparent, it's there forever. Anybody who has access to it can see it. So it's immutable proof that an action was taken at a given time between a particular participants. It's there for the public to see. So how does blockchain work? I'm on time. All right, I'll speed up a little bit. Since blockchain isn't centralized, there have to be a lot of rules for all the participants that are participating with it. Those rules are mostly technologically driven. So if you participate and if you make modifications to the blockchain, you can only do it with the technology you're provided. The blockchain consists, not surprisingly, of a series of data called blocks. And when put together, they form a blockchain. Every time data is added into, data is aggregated, and it's put in the form of what is called a block, and at an appropriate time, as determined by the owners of that particular chain, the block can be updated to the chain. It becomes a part of the public record. It's there forever. So when and how those blocks are added depends on how the blockchain is being used. Now, I said at the outset that Bitcoin and the blockchain are two different things, but it's difficult to talk about the blockchain without talking about the Bitcoin model because that's really what brought it into focus for most people. There are a lot of other uses, but Bitcoin is the one that people are most familiar with. So I'm going to talk a little bit about the Bitcoin model. This is getting a little bit in the weeds here, but I think it's important. When I look at this and I think about the legal ramifications for the purpose of a law firm, we need to be able, how are we going to contract for this? How are we going to anticipate vulnerabilities so that we can build contracts around to protect our clients from them? And to do that, you really have to understand how the technology works and how it's built. So using Bitcoin as an example, the blockchain can be downloaded by anyone. As I said, I downloaded it myself a couple of years ago. And the individuals who work on the blockchain, who maintain it, are called miners, as in miners for gold, except in this case they're mining for Bitcoin. The miners verify that the transactions are valid, and they do so by accumulating data that goes along with those transactions that they receive through the internet. They accumulate it into a block. And the header of the block that they have is taken in part from the header of the previous block. And it's put together in something that's called a hash. And that hash is then combined with a random number that is generated by blockchain called a nonce. And the hash and the nonce are combined, and they go into the header of the current block that's being worked on by the blockchain. So the miners, once they have developed their hash, they verify that all the transactions, all the data in their block is valid according to the rules of the exchange. And then to finalize the block and to include it in the chain, Bitcoin requires that they solve a proof of work problem. It's a mathematical proof. And the reason they do that isn't necessarily for security. They do that to slow down the development of blocks, because Bitcoin has a finite number of blocks that they want to use in their exchange. And if you didn't have a way to slow down the work that the miners are doing and to regulate it, then the blockchain would be used up almost immediately. So they have the mathematical proof that they use to seal a block. The complexity of that proof is predicated on how many miners are working at that time, so that, believe it or not, the blockchain is updated, I believe, about every 10 minutes. If less miners are working at any particular time, then the complexity of that problem is less difficult, so the problem will be solved faster, and the chain would still be updated every 10 minutes. Once the miners agree that the problem is solved, the hash is stamped, and the block is added to the chain, and it's visible to the entire network. Again, the entire network is everybody who's downloaded the blockchain on their computers or who participates. So another way of looking at the hash, it's like a digital version of a wax seal. You know, when your grandparents all had a letter stamp, and they put, before they had sticky stuff on the back of an envelope, they closed the letter and they put wax on it and they stamp it with their seal. And when the recipient got that letter, if the seal was broken, if it had been tampered with, they would know that somebody had looked at their letter. In the Bitcoin context, the unbroken seal, or hash, confirms that the block, and therefore every block before it, is legitimate. So when a new block is added to the blockchain, the entire network can see it, and they can confirm that the transaction took place. If the content of a block is disturbed, the hash changes. And because the hash is comprised of part of the header from the block before it, and the block after it is comprised as part of the header of that block, you change the hash on a block, it messes up the whole system. So anybody who's looking at it can know that a block has been tampered with, that it's no longer valid. And there are tens of thousands of backups of every blockchain because it's public. And everybody would know that it's been tampered with, so they wouldn't use a version that's been tampered with. They would continue to monitor the most recent version they had that has not been tampered with. So it's a really unique way to use the public to verify the validity of transactions. I think I went through most of this. You know, miners are compensated every time a miner or a group of miners completes a block. They're paid in Bitcoin. They're paid 25 Bitcoin. This morning, a Bitcoin, I believe, was $455.06. So 25 Bitcoin is nothing to sneeze at, but there are thousands of miners working to do it. So these days, miners are usually not acting as individuals. They're working in groups with other miners to help solve these problems. And the miners will split up the Bitcoin reward that they get when they solve a problem and add a block. Miners can also receive additional fees by agreeing to include particular transactions in their block. So as an incentive to complete a transaction, somebody might offer a reward to a miner to include it. So if I'm a miner and I'm accumulating hundreds or thousands of transactions, I believe Bitcoin does about 100,000 transactions a day. If I'm considering which transactions I'm going to include, I want to use as many as I can. But if I see one that has a reward, I'm certainly going to incorporate that in. So somebody might offer a small Bitcoin reward to encourage miners to incorporate their transaction into the most recent block. As the exchange matures and the number of blocks I said previously is finite, as they run out of blocks, the 25 Bitcoin rewards will no longer be available, and the system will be powered entirely by rewards that miners can receive as additional fees for including data in a particular transaction. That's pretty much it. Just quickly to sum up, what are the main characteristics? Security. It's a really unique way to use the public to guarantee that something is secure, not by keeping it private, but by letting everybody see it. It's anonymous, but it's not secret, transparent to everybody. Transactions can be programmable. You can include, for example, a monthly mortgage or a monthly bill pay, or it can be conditional, like you can release items on a certain condition. You can, I believe the example Josh had in one of his presentations was you can send meat from Japan to the United States and enter into an if-then equation. It's easy to program. Say, if the meat leaves at this time and it stays consistently below 34 degrees and it arrives at my house at this time, then you automatically will receive a payment. Anything that's a if-then scenario can be programmed into the blockchain and be used as a smart contract. That's it. Josh is going to talk more about state of the market and individual uses for the blockchain.
Yeah. So, John, that was really great. Thank you so much. The Bitcoin sort of burst onto the scene in 2013. Saw a lot of investment in 2013 and 2014 in Bitcoin specifically. 15 and 16, we've seen a transition more to really blockchain and enterprise focused solutions and enterprise kind of business to business or system wide uses. And so the reason we're talking about this, one, beyond the fact that I think it's just really interesting, is there's a lot of money. There's a lot of money going into it right now. Got two slides from the most recent CoinDesk State of Blockchain that really highlights that point. The first, the one on the left, indicates the amount of institutions investing in blockchain. This is not Bitcoin, but blockchain-specific technology over the last 3 quarters, and you can see it's really increasing. And the deals that we're seeing are of a pretty good size, and there's a real healthy appetite for investment out there. So that's one of the reasons why we're talking about it and why people are interested. Similar sort of concept on the right. There was a small dip as far as investment in Q4, but in Q1 you've got 160 quarterly and $160 million invested in that quarter. Average deal size is a little over $11 million. So real investments into real companies with real ideas. And I think, and this will bear out as we go through, some of the companies have some pretty interesting ideas. Some of them have some pretty mainline ideas, and then there's some pretty radical ideas out there as well. And I think the market is nascent enough to where time will tell who the winners and losers are, but there's a lot of thought and energy right now going into what this market looks like. And one of the reasons that there's been this increase is that there's a lot of ways to collaborate and a lot of companies that are collaborating. And that's really important for a couple of reasons. The chart on the left is a chart on who is participating in the Hyperledger project. Hyperledger project, very basically, is a software consortium that looks at problems with blockchains and how to solve them. Mike, if that's something you want to touch on later, feel free. I see Jim is a recent add to the list there on the right. But basically, what you'll notice from that slide is there are a lot of really big, well-financed companies who are looking hard in the space and trying to come up with solutions. Similar on the right, Microsoft Azure has a blockchain as a service, which continues to, as the chart says, gain traction. And it's, a lot of these enterprise players like Microsoft, Amazon Web Services are getting into the blockchain game. Nobody wants to be left behind. And when we're talking about the blockchain game, what does that mean? Couple of use cases that are interesting. But before I talk about what the use cases are, I want to explain how they fit in. So this is sort of the ecosystem. What John was talking about when he was talking about Bitcoin would sort of fall in the upper left quadrant of this chart here, which is a public platform. So like John said, something that anyone can get on, anyone can use. I can download a wallet, I can buy Bitcoin, it's easy. Ethereum, which many people who know what's going on in the blockchain community are familiar with Ethereum, is an equivalent, I'm not sure equivalent's the right word, but is a publicly accessible blockchain. So app developers who want to put out a product can use Ethereum similar to the way that if I want to design a website, I can use the internet. That's probably the best example for it. There are also private blockchains, Ripple, Blockstream being an example. And then, so that's on the platform side. At the top and the bottom, you've got software as well. So we've already talked about the Hyperledger project, which is a public software. And then a lot of companies and a lot of investment right now are falling into the private software space. They're utilizing some of the publicly available blockchains that are available, and they're trying to figure out solutions to problems. So one of the most well-known is the R3 consortium, and their focus is on finance. You can see in the chart on the right, 42, as of this graph, massive banks are kicking the tires on blockchain, trying to figure out how a blockchain solution can help with their role as an intermediary in the financial system. One of the pilots that was recently tested out with several of these banks through R3 was sort of for a short-term corporate bond. So can you trade corporate bonds on a blockchain? I think it was using Microsoft's Azure platform. But, I mean, basically the reason, and it's interesting, right? The reason they pick bonds is they're relatively simple documents. The payment terms are predetermined and fixed. And so if you're trying to figure out a way to transfer money in a digital environment that's more complex than a Bitcoin, bonds are a great place to start. But you can see there are a lot of different areas that are being looked at. And like I sort of touched on, there are several reasons why the financial markets would be interested. And a lot of these are what John touched on as well. But they're, looking for open source, non-anonymous types of solutions, and blockchain, when you're talking about either private or permissioned blockchains, are a great solution there. And then what's also interesting, I wanted to point this out, there are lots of use cases available. Some are better than others. So take a look down this list and sort of see what's available. The ones that I think are really interesting are, and I won't speak to SKU Chain directly, but around the supply chain area, supply chains, which I'm going to talk about in a minute, make a lot of sense in a blockchain area. Land titling with Bitfury, they announced that recently. Basically, it's a way of keeping track of who owns what parcels of land in sort of less developed countries, and it's in areas where keeping records is hard, but there's wide access to sort of technology and cell phones. It makes a lot of sense to jump a lot of technological leaps and go straight to blockchain when you want to implement sort of those basic services. Moving up the list, Chain is looking at similar to the types of solutions we talked about for R3, but ways to disintermediate the financial system. Vunk, which I had not heard of until recently, is a way of trading your virtual junk in video games. So if that's digital points you collect or digital currency you collect in video games or what have you, there's a platform for trading it. So anyway, as you can see, there's a lot of different options right now. DARPA, even at the bottom, is testing unhackable messaging systems, which, of course, obvious military implications and advantages there. Speaking about the supply chain for a minute, because I know a lot of our listeners are in markets that rely heavily on supply chain, the uses for supply chain are really interesting because it solves a couple of problems. When you have multiple parties who are either competitors or their interests are not totally aligned, blockchain allows you to solve that trust problem and allows you to share records easily and efficiently. So, for example, if you wanted to track the history of a part across the entire supply chain, blockchain technology would allow you to do that in a way that is transparent, in a way that is irrefutable. And so there's a lot of interest in that respect. And then when you combine that thesis with sort of the smart contract thesis that John was talking about earlier, where you can automate certain actions. So in John's example, if you're sending beef across from Japan to the United States, you use GPS. When it gets to a coast or when it gets to port, payment is initiated. All of that can not only be recorded into a blockchain where the record is immutable, but you can also automate payment. So there's a lot of really interesting sort of use cases and thoughts around supply chain. We've talked about smart contracts some. We've alluded to it. I want to hit that a little harder so that people understand what we're talking about. Especially for any legal folks on the call, smart contracts in their most basic form are not the kind of contracts that lawyers tend to think about. They are either one or a series of if-then statements like John was talking about. If you wanted to take a betting example, because there's some gambling applications that are being looked at, if a certain whatever decision maker, call it ESPN.com or call it a casino or whoever, makes the determination that a certain fighter won a certain boxing match, then whoever bought into the blockchain or placed a bet on the blockchain would automatically get paid out. That's kind of one of the most basic sort of theses around smart contracts. For a more technical definition, they are automated programs that can carry out the terms of any contract. So when you're thinking about drafting a full-blown contract from a legal perspective, the smart contracts that you would be negotiating as well would probably be an attachment and would be some programming language that you would include. The advantage is that once it's programmed, you can't change, no one can change the program unless that mechanic is also built into the smart contract. So it's sort of a fire and forget contract. One of the terms I heard it described as at a conference is that it's injunction proof, meaning that not even a court could require non-performance on the contract. And I think as a business perspective, that's a really interesting and powerful concept. And as a legal perspective, I think it's terrifying to some lawyers. So it's one of these issues that needs to be sort of evaluated and reviewed. But when you think of one-off smart contracts, I think they're already in the market, and uses for them are going to only I want to say increase, but I don't think that's a strong enough word. You're going to really see an explosion in these kinds of technologies and these kind of smart contracts in use. So those are really simple ones. And then a recent concept that I came across that I think is just absolutely fascinating, and I had an oh my goodness moment, were around distributed autonomous organizations, or DAOs. And a DAO is at its very core a lot of smart contracts put together. And so when I think about a DAO, it looks a lot like, well, let me take a step back. So it's a lot of smart contracts that are put together into one sort of, let's call it ball. And in the specific case of a DAO, it's to create an entity. So an organization that by its members voting can take action. So a DAO to me sounds a lot like a bylaws or an operating agreement of a company. And so the news that came out this week was, I'll call it a fund, even though they went to great lengths to not call themselves a fund for legal reasons, called The DAO, just raised $50 million worth of Ether, so Ethereum.
117 as of yesterday.
117 as of yesterday. So get out your paychecks. And what the goal of the DAO is to invest in other blockchain companies and products. And the way, to my understanding, the way they make their investments is through a vote of the unit holders or the Ether holders, or I don't know what term they're giving themselves, but a vote of the members up or down. I think this is really fascinating for a couple of reasons. One, probably some good money to be made there. Two, obviously this is, it's not in the United States. They're based out of, I forget which European country. It might have been Germany, Switzerland. So different legal implications. In the United States, this would be pretty confident against security laws. But another example of where this technology is not only ahead of regulation and ahead of sort of general thinking, but very far ahead of both of them. And so that's something to look at and keep in mind as the technology develops. So now I'm gonna kick it over to Micah and have you tell us a little bit. We've sort of given some background, but I'm gonna hopefully have you tell us a little bit about Gem, and then while you're doing that, I'm gonna try to load your slides up.
As am I. One second here.
I've got it.
Have these open.
Perfect. Here we go.
Yeah, so I'm Micah Winkelspecht. I'm the CEO and founder of Gem. We've been in the Bitcoin and blockchain space for, well, the company's officially been there since the beginning of 2014. I've been involved for about 3 years professionally. So I'm a developer by trade. I was really originally interested in Bitcoin and the blockchain because I thought it was a sort of technical marvel. And that's really what attracted me to it, was the true technological innovation of Bitcoin. You know, I've watched this market change very rapidly since I got started. You know, when I started, I went to my first Bitcoin meetup, and it was 15 people in a park in downtown LA, 2 Silk Road drug dealers, you know, basically talking about how to buy and sell, you know, drugs on the internet. And it's, you know, I say about a year and a half ago, we started getting approached by several of the largest financial institutions in the world who were saying, hey, you know, if this technology can work for this little startup bootstrapped currency, maybe it can work to help us move stocks, bonds, derivatives, futures, energy, pretty much let's digitize all assets and put it on this thing. And then more recently, I'd say in the last 6 months, the conversation started to shift away from just financial applications to a much broader set of applications around data and moving value of all types. And so that's sort of the big picture. A little bit about where Gem fits into this ecosystem. So we've raised just a little under $11 million. We're part of one of those graphs, we just raised our Series A in the first quarter of the year.
Congrats.
Thank you. You know, so our focus is actually on non-financial applications of blockchain technology. So we're not exactly in the business of moving money over the internet. What we're interested in is essentially unlocking multiple disparate data silos across an entire industry. And our focus is at the intersection of multiple companies who are participating in some sort of organized workflow in an industry. Where data needs to move between companies, but you want to be able to do that in a way that's very secure, that makes strong guarantees around data confidentiality, and also data integrity. And if you have data confidentiality and data integrity, then you can start to think about ways to move data that don't require any sort of central clearinghouse or counterparties. And typically, when you look at markets and the way data moves, it usually flows through some sort of central clearinghouse or counterparty. So in a lot of ways, we're building new systems that can either eliminate or streamline those types of processes. So the core of what we offer is GemOS. GemOS is essentially an operating system for blockchain technology. So if you think about Bitcoin, so I like to think about Bitcoin as it was really an attempt to build the world's first global calculator or abacus. It's a system that's designed to basically move around digital units of currency from one account to another and to keep track of that on a global ledger. And really, you can do some very basic functions. You can add, you can subtract these digital units of currency. And then you can start to program some basic versions of smart contracts, although Bitcoin was very, very limited in the language that it allowed. So you can't really do extremely complex contracts. You can do very, very basic ones. Some of the systems that are now being developed outside of Bitcoin, like Ethereum, which is what the DAO is based on, the distributed autonomous organization that just raised $117 million. And then also projects like the Hyperledger project, which are, they were really sort of founded by IBM, but are now in the care of the Linux Foundation, along with probably another 40 companies, including ourselves, who are helping to contribute to and maintain that project. So the Hyperledger project, Ethereum, these are really attempts to build a global computer, a computer that essentially can run arbitrary programs and applications and can have infinite complexity in the types of smart contracts you can build. And so, if you can think about like any sort of application or any sort of workflow that currently exists in business, we can now model that on top of a global computer system where you can have this process run in a highly trusted environment that's shared by everyone, owned by no one. And so that's the attempt of those things. Where we fit in is we're the operating system for the global computer. So we are the layer that sits on top of that core protocol layer that gives you a lot of additional functionality around building out strong identity models, so keeping track of the individual actors within the system, and about moving data and connecting disparate data silos on a network. And then really we're focused on the intersection between the two, which is connecting identity to data so that you can make strong guarantees about who has access to what data at what time. So there's four main components to the operating system: Gem Identity, Gem Data, Gem Logic, and Gem Network. So Gem Identity is really about applying modern cryptographic protocols, public key, private key infrastructure to authentication in a way that really hasn't been popularized. The technology is not new. It's been around since the 1970s. But the use of it has been very limited up to this point. So we're making it a lot easier for businesses to employ this stuff. And it's really core to how blockchains work. So public key, private key cryptography is one of the core tenets of all blockchains. Gem Data is about essentially connecting arbitrary data sources. Those can either be private data sources if you want to maintain full ownership and control over your data source, but you want to be able to allow selective access to, say, another organization. Or there's new models that are actually being developed that are looking at how to build shared data repositories across an entire network. Things like IPFS, which is called the Interplanetary File System, which I think is a pretty clever name. These are essentially distributed data stores, and so we're able to connect to any arbitrary data store, whether it's private or global. Gem Logic is about, so once you have strong identity, you know who your actors are, and you have strong promises around data integrity and data confidentiality, you can start to build an entirely new class of applications that you really just couldn't do before, where you can essentially automate or streamline cross-industry workflows that leverage and share data across a network without any controller in the middle, any owner of the network. So just by essentially connecting onto this federated network with other partners in your industry, you can create applications and workflows between your companies in a new way where you're all sharing the infrastructure. And so GemLogic is all about building those types of application layers. And then Gem Network is essentially about how you connect to either existing or new blockchains. So we've envisioned a world where there's not going to be one blockchain, but there will be many blockchains. There will be purpose-built blockchains in each industry. Some blockchains are going to be more focused on moving money or financial value. Some blockchains will be more focused on moving data. There might be a industry-specific blockchains around, say, clinical records for healthcare. And so you want to have a system that allows you to be flexible and build on top of many networks. Kind of already went through a lot of these things, so I'm not going to go too much deeper. One other thing to note is that this is a very new technology. So the underlying protocol layers are still very much in flux, and they're still being developed. And so when you're building on top of this, it's really nice to have an abstraction layer where you don't have to focus on building and keeping up to date on each protocol that you're trying to integrate with. So that's a function that we really provide. We sort of safeguard companies that we work with. We safeguard their investments because they can essentially build logic on top of Gem and not have to worry about the underlying details of the underlying blockchains that change all the time.
Can I ask a really basic
sure.
question? What language are you coding in, and do we use traditional software coding languages in conjunction with Gem, or do you have your own language that you use on your platform, and how do they connect and interact?
So there's different parts of the stack. So the lower you go, the lower level language it is. When we're dealing with private key management and infrastructure, we're dealing with actually bare metal hardware so we have key management solutions that are using hardware security modules, which are basically hardware that goes into major banks to protect financial transaction networks. And that layer is going to be like very low level C code. The main core platform is written in Java, but the layer that most of our customers will interface with is either through a REST API, so they can use whatever language they want, or when we're talking about smart contracts are, there's a lot of experimentation in smart contracts, so these are early days. The current language that's very popular right now for smart contracts is something called Solidity, and it's modeled very closely to JavaScript, so it's very easy to read. You don't have to be
It's not a special skill set.
No, well, you need a little bit of experience with it, but it's designed to be something that's pretty human readable. So, as you're talking about if-then statements around, if it does this and then do this, most people can read that pretty easily, and you don't necessarily need like a very experienced programmer to build smart contracts. So that's the layers that you're going to be working at mostly. But our platform's written in Java. We thought that was a sort of a good enterprise choice. So just sort of an example of how this works in practice. You think about a hospital. So a hospital is going to maintain its own set of data records around patients' information. But occasionally you need to, you have a patient come into the hospital and you need to get more data from other providers about that patient. So you need to be able to call out to, other providers to be able to get access to the patient record. Right now, the systems that are in place for doing those interchanges, you're either going through some central provider like an EMR solution, or you might go and reach out directly to a provider and do some sort of bilateral trade. And a lot of times you're doing fax confirmations and signature processes, little physical signature processes. We can model that same thing, except actually build this into automated workflows where providers can connect directly with each other to keep their data separate, but selectively share it when a hospital needs it. And a lot of these systems can be built either around current EMR solutions, or potentially we can actually work with EMR solutions to help streamline their existing software. And we're trying to build standards-based networks where data can be very rapidly and easily moved and shared across a network with very strong guarantees around access control, permissions, and to make sure that everybody has the exact right data at the right time and no more.
Yeah, I mean, I
Yeah.
think that is, sorry to interrupt, that
Yeah, sure.
such a powerful need, and there hasn't to date that I know of been a technology that's been able to really accomplish a lot of those issues. And it seems like, kind of based on the problems you're outlining, the blockchain is a really good candidate for solving a lot of those problems.
Yeah, well, I mean, if you think about just sort of the history of complicated systems, I mean, if I want to exchange, say, $100 with you, it's very simple, right? I pull out a $100 bill and I hand it directly to you. As soon as you start to increase the number of participants, and we're starting to build a network of people like at this table, the number of one-way connections, the number of bilateral connections we'd have to make in order to build this network, it starts to multiply, and it's exponential in growth, right? And so what happens is, as the complexity increases, pretty much in every system, you have somebody who says, you know what, I'm going to become the middleman in this situation, and I'm going to create all the connections, and you just connect through me, and I'll make it much more efficient. If you think about like just the history of how systems have been structured for literally thousands of years, this is how it's been done. This is a technology that for the first time gives us all the benefits of bilateral interaction, bilateral trade with each other, without the need for the middleman who sits in the middle, because the network itself is the middleman. And so it's a technology that is really transforming. I mean, a lot of people say, we're revolutionizing how we're doing, we're revolutionizing this industry, we're revolutionizing that industry. Yeah. This is truly a revolutionary technology because it actually changes the way we think about organizational structures in business and in politics, for that matter. So it's a pretty big concept.
Yeah, it's great.
Yeah.
Is there one just quick question for you? I don't want to take you off script, but when you sort of deliver this message to key partners, what's their, when they are maybe learning about blockchain or know a little bit but don't know a ton, what's their response?
Well, I think I've been surprised a lot. So, I think when we got into this 3 years ago, it was a bunch of crypto anarchist libertarians, trying to replace the United States dollar. I was very shocked by the level of interest that we started receiving from the largest companies in the world. And that was about a year and a half ago. But at the time, it was still very, very nascent, very new, even in the financial industry. And even at that time, Jamie Dimon and many others were saying, this will never work. It's just, this is a stupid technology, like, nothing to see here. And it went from that kind of language to, a year later, there's not a single large financial institution in the world that doesn't have an active team developing and building solutions with blockchain. So I've seen that shift in the financial industry, and right now in every other industry, whether it's supply chain or healthcare or any other major industry, we're still at this sort of day zero. But I think it's going to happen a lot faster. The adoption is going to happen a lot faster in some of these other industries than it did even in the financial industry, because when the financial industry came to the table, the only thing they could compare it to was a bunch of crypto anarchists trying to replace the United States dollar. Now, if you're in healthcare, you're a leader in healthcare, you're a leader in supply chain company, you can look at what the financial industry did, and they've sort of already validated it. They've already pushed the technology much further. So I think that the adoption curve is going to be much faster now.
Yeah, I mean, you're almost looking at where you don't want to be the head of IT or the head of strategic development at your company and have your boss come and ask, well, why aren't we looking at blockchain?
Yeah, and we see that increasingly so, right? So people are coming to us now because their bosses are saying, hey, why don't we have a blockchain strategy? Which is very different than, how it was, say, 2 years ago when it was really, small champions within an organization trying to push it up the chain. Now it's coming down the chain, which is very different.
Great.
Yeah.
Unless you've got anything else, we can open it up for questions.
I'd love questions.
Yeah. So if there's anyone on the line who wants to ask a question, feel free. Or if you've got the chat box, that's probably the best way to reach us. Feel free to type your question in. And then while we're waiting on that, I've kind of got one more. Is there, and John, if you have, okay. What sort of, we were talking about the timeline. Are there industries or use cases that you think are going to be kind of the next big one after, sort of finance is kind of the hot, right, is kind of the hot one right now. You've touched on supply chain, you've talked on healthcare. Are those where you think the next wave is, or are there other areas, or do you think it's going to be sort of a tidal wave approach where lots of industries start bubbling up at the same time?
Well, obviously we've made a pretty big. I mean, we didn't talk about it here, but we've made a pretty big jump into healthcare. So we just announced our partnership with Philips Blockchain Lab in Amsterdam. And we have more coming in the healthcare space. So I see that as a pretty big growth area. I think there's a lot of need. There's a lot of disparate data silos in the healthcare industry. There's also a lot of inefficiency in even the payment side that, you can take payment cycles from 90 days down to 30 days, and that would be a massive, massive improvement. So I think, when you look at some of the primary use cases, provenance is a really big one, which is big in supply chain, but it's also a really big issue for counterfeit goods for major brands who are just getting rocked by counterfeit goods in the marketplace. So a lot of brands are looking at this as a way to ensure the provenance of their luxury goods as they go through the marketplace. I think so I look at blockchains actually as I like to call it an API killer. So APIs, application programming interfaces, are used pretty much at every major company in order to connect to their market partners. Right. Data flows bilaterally through an API connection from one company to another, and you see them everywhere. I think that this is a technology that's going to replace the paradigm of APIs. So rather than push and pull between two databases, we're going to have shared infrastructure where we're leveraging and sharing the same data repository amongst multiple companies. And the reason why we're able to do that is because of the security promises and the confidentiality and integrity promises that blockchains have created. So this is a way to do business that really didn't exist before.
Great. We've got one question. This can be to all three of us. How do you see this technology affecting the insurance industry? Are they more likely end users, or will they be issuing policies around this technology?
Yeah.
I've got some thoughts, but if you want to...
Go ahead.
So one of the things we're seeing right now are there's a lot of interest. I think we were talking last night about a major insurer trying to put on a hackathon to try to figure out how they fit into the market. Some of the funding that we've seen and some of the products we've seen, there was one company we mentioned earlier in the presentation who is funded by insurers to try to crack down on diamond theft. And there are several other kind of companies that get to insurance fraud as well. So I think that's going to be the first wave, is companies who are not the insurers, but who are funded by the insurers to try to reduce the number of claims or reduce the amount of fraud. As far as issuing policies around the technology, I don't know if anybody is.
There are a lot of people that are looking at this. So I think one of the areas. Okay, so in general, changing traditional models of how things have always worked is always very difficult and slow, right? So one of the things we always try to encourage companies that we're working with is to look at how this technology could be applied to maybe create new products or new ways of doing things that you couldn't do before. In the insurance industry, one of the areas that they're really, really focused on, especially as it relates to this technology, is ensuring the new sort of sharing economy where, the traditional models of ownership of an asset are changing and are now being shared. So if you think about like ride sharing, for instance, can we provide auto insurance where insurance is issued on a per ride basis as opposed to insuring a car or having an annual policy? And then on top of that, they want to start to leverage more and more data. So for instance, there's devices that can be plugged into a car that can essentially track the data usage of a car as an asset. And then if you have that data, you can actually insure that driver differently based on exactly how they're using the car. So you can get a lot more metrics, a lot more information that you can use to inform policy and to inform pricing. And so these are areas that they're exploring and blockchains could be the sort of underlying fabric or data layer that allows for all of that data to get aggregated that they can then leverage and use to make new policies. And then they can use smart contracts to potentially automate payouts of those policies. So think about like micro policies, basically.
That's a deep dive.
Yeah.
I think insurance companies have done a woefully poor job of creating cyber insurance policies that really work. You know, they're more identifiable by the gaps in them than they are for what they covered.
Yeah.
And the blockchain is they can't wait for this new technology to come on, would be my sense, because it's much more secure. Their risks are much more clear to them, and they're not they're not waiting for the next hacker to figure out how to break the policy they just got. You know, this is something that appears to be.
Yeah, that's actually a good point. So there's another area of insurance specifically where they're really focused, which is actually just general workflow processing, right? So in an insurance claim, there's many different constituents that need to participate in the life cycle of a claim. So, you know, you can either go through some sort of clearinghouse, like in the medical industry, there's tons of clearinghouses for medical claims data where they're passing data back and forth. Or you can leverage a blockchain to essentially manage the state and life cycle of a claim from point A to point B to point C to point D throughout the entire life cycle. The other thing is that in an insurance claim, there's a lot of sensitive data that's also being passed around alongside that claim. So in medical claims, I mean, there's very, very personal information about somebody's medical clinical data, but that's true in a lot of other insurance as well, where sensitive information, personally identifiable information is being passed along with the claim. And so they're looking at blockchains as a way to help secure that data.
Next question, and Micah, you and I were actually talking about this one last night, and if you want to jump in, feel free, or I'm happy to. How does the application to hospital patient data handle with HIPAA issues and privacy issues?
Yeah. Well, it's exploratory right now. So I mean, Philips is based in Europe, and so the standards that they operate on are not necessarily just HIPAA, but they're going even further to like German data privacy standards, which are the strongest in the world, really. I think what's interesting about HIPAA is, unlike in the financial industry where the regulations are more about anti-money laundering, know your customer requirements, they're more concerned about the overall health of the system. Whereas in the healthcare industry, like HIPAA regulations are really about protecting the patient. And blockchains actually are really good at protecting the privacy of individuals. So here you have a case where regulation and blockchain technology actually are very much aligned. So I think it'll be an easier.
I think that's exactly right. I mean, sort of like we discussed, I think the technology in an ideal setting really solves some problems that HIPAA was designed to create. My concern is, as with any new technology, that the regulations can't get out of the way of a better solution. But I think you're exactly right that the ability for a patient to control who sees the record, when they see the record, there to be a log of when that record was accessed, is all exactly kind of addressing the concerns that HIPAA was created to.
I mean, so regulation is no doubt an issue and a stumbling block for this technology, and largely it has to do with the fact that regulators are just never going to be caught up to the technology. Yeah. So, like in the financial industry, I mean, we went from having regulators basically try to shut it down to having massive education campaigns, and now we're at the point where when we go to a financial conference around blockchains, every major three-letter agency shows up with their representatives. They're speaking on panels, and they're very pro, technology. So it's really an education issue. And there's a group called Coin Center that does a lot of really good work around this area, where they actually go out and educate lawmakers, they educate regulators, and they've been doing awesome work. Yeah.
Yep, and it looks like that's the last question, and it's now 1:00 Eastern. So thank you, Micah. Thank you, John. I really appreciate everybody attending.
Thank you.